Margaret stepped away from work at 66 following 32 years serving as a school administrator. She followed every recommendation perfectly. She maxed her 401k contributions for 2 decades. She never tapped into her IRA. She lived beneath her income. She watched her portfolio climb from zero to $1.1 million by the day she stopped working. And then the IRS began penalizing her for it. Not because she violated any rules, not because she cheated on her returns, because the tax code is structured in a manner that transforms a sizable traditional IRA into a weapon the IRS deploys against you. Every dollar Margaret put away is now a dollar the IRS commands. They determine when she takes it out. They determine how much. And every mandatory distribution sets off a chain of taxes that she never anticipated. In 9 years, when Margaret reaches 75, the IRS will compel her to pull more than $44,000 from that IRA, whether she wants to or not. The mandatory distribution will drive 85% of her Social Security into the taxable zone. It will tack on close to $5,000 to her federal tax bill versus what she would owe without it. It could activate Medicare IRMAA surcharges that pile on more than $1,000 a year onto her premiums. And the figure climbs every single year for the remainder of her life, because the RMD percentage rises with age even while the balance dwindles. Margaret did not err by saving. She erred by saving in the wrong vehicle. And the IRS is not going to explain the difference to her. I am going to walk you through precisely how this unfolds, who it strikes, how much it costs, and the 5 specific moves that can stop it. This is the most important math most retirees will never see until it is too late. Before I dive into it, I need to be clear. I'm not a lawyer. I'm not a CPA. I'm not a financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational illustrations grounded in current tax law and publicly available IRS information. Always consult a qualified tax professional for your specific situation. My name is Timothy, and if you are new here, this channel is for one specific group. Retirees and pre-retirees over 60 who want to understand how the IRS actually works in retirement. Not the version your 401k administrator gave you. Not the version your employer's HR department explained in a PowerPoint. The genuine version with real figures in plain English. If that describes you, subscribe right now, because the video I'm releasing next week is going to reveal how much you really have in your 401k by age after the IRS takes its cut. And that one is going to transform the way many of you think about your balance. Drop a comment right now. How much sits in your traditional IRA or 401k? You don't have to be precise, just round to the nearest 100,000, 200,000, 500,000, a million, whatever it is. I read every single comment, and the most frequent balance range is going to determine which example I use in the follow-up video. 2 seconds. Do it now. Let me start with the math that nobody shows you. The IRS does not tax your traditional IRA while it grows. That is the arrangement. You contribute money, you receive a tax deduction, the money grows tax-deferred for decades, and the IRS waits. They wait patiently. They wait for decades because they know that at age 73 or 75, if you were born in 1960 or later, they get to dictate how much to take out. And every dollar emerges taxed as ordinary income. Required minimum distributions are computed by dividing your IRA balance as of December 31st of the prior year by a life expectancy factor pulled from the IRS Uniform Lifetime Table. At age 73, the divisor is 26.5. At 75, it is 24.6. At 80, it is 20.2. At 85, it is 16. At 90, it is 12.2. Watch what that does to a 1 million IRA. At 73, the RMD is roughly 37,736. At 75, even if the balance has fallen to 900,000, the RMD is roughly 36,585. At 80, if the balance is 750,000, the RMD is roughly 37,129. At 85, if the balance is 600,000, the RMD is 37,500. At 90, if the balance is 450,000, the RMD is 36,185. Notice something? The balance is falling every year. You are pulling money out, you're spending it, the account is contracting. But the RMD figure barely shifts. It remains in the $36,000 to $38,000 range for decades, because the divisor gets smaller every year. The IRS engineered the table so that the mandatory distribution stays large, even while your account contracts. By the time you're 90, you are required to pull more than 8% of whatever remains every single year, whether you need it or not. Every one of those dollars is taxed as ordinary income, not capital gains, not qualified dividends. Ordinary income at the same rate as if you earned it at a job yesterday. And if you miss the deadline, the penalty equals 25% of the amount you failed to pull out. Under the Secure 2.0 Act, that was lowered from 50% and it can fall further to 10% if you fix the mistake within 2 years. But the wiser play is to never miss it. Set up automatic withdrawals. Treat the deadline as non-negotiable. There's also a snare in the first year. If you turn 73 in 2026, you can postpone your first RMD until April 1st of 2027. That sounds like a present. It is not. If you postpone to April, you must also take your 2027 RMD by December 31st of that same year. 2 complete RMDs in 1 calendar year, both taxable, both stacking on your return, both pushing Social Security into the taxable zone, both pushing you toward a limit. The postponement is almost never worth it. Now, let me show you what that does to the rest of your tax picture. Because the RMD itself is not the punishment is what the RMD does to everything else. The first cascade is Social Security taxation. The IRS uses provisional income to figure out how much of your Social Security benefit is taxable. Provisional income equals your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. For a single filer, if provisional income falls below $25,000, Social Security is tax-free. Between $25,000 and $34,000, up to 50% is taxable. Above $34,000, up to 85% is taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000. Those thresholds have been frozen since 1983. They have never been adjusted for inflation. Now take Margaret. She receives $36,600 in Social Security. She has no pension. She has modest savings interest of around $2,000. Without any IRA withdrawal, her provisional income equals $2,000 plus $16,800, which is half her Social Security. That comes to $18,800. She is below the $25,000 threshold. 0% of her Social Security is taxed, but she needs income to live. She pulls $42,000 from her traditional IRA. Now, her provisional income equals $42,000 plus $2,000 plus $16,800. That comes to $60,800. She is deep in the 85% zone. $27,280 of her Social Security is now taxable income. That is $27,280 that would not appear on her tax return if the IRA withdrawal was not there. At the 12% rate, that equals $3,274 in additional federal tax. At 22%, it equals $6,001. Just from Social Security being driven into the taxable zone by the IRA withdrawal. This is what financial planners label the Social Security Tax Torpedo. Every dollar of IRA withdrawal does not just get taxed at its own rate. It pulls Social Security income into the taxable zone alongside it. The effective marginal tax rate on IRA withdrawals in this range can hit 22%, 30%, even 40% when you factor in the Social Security cascade. You appear to be in the 12% bracket on paper, but you are paying 30% in reality because of how the math compounds. Did you know about the Social Security Tax Torpedo? Drop yes or no in the comments. This is the concept that transforms how people think about their IRA balance. And I want to know how many of you are encountering it for the first time. The second cascade is Medicare IRMAA surcharges. IRMAA stands for the Income-Related Monthly Adjustment Amount. It is a surcharge tacked onto your Medicare Part B and Part D premiums that triggers when your modified adjusted gross income passes specific thresholds. For 2026, the first tier begins at $109,000 for single filers and $218,000 for married couples filing jointly. For Margaret, as a single filer, her income from Social Security, IRA withdrawals, and savings interest places her well beneath $109,000. She is safe for now. But watch what unfolds as her IRA expands. If Margaret had built up $1.5 million instead of $1.1 million, her first RMD at 75 would be roughly $61,000. Add that to her Social Security and savings interest, and her modified adjusted gross income reaches roughly $91,600. still below the IRMAA threshold. But if she performs a Roth conversion of $20,000 in the same year, her income surges to $111,600. She just crossed the $109,000 line by $12,600. The penalty for crossing that line by even $1 is not proportional. The first IRMAA tier tax on roughly $81.20 per month to her Part B premium. That equals $974.40 annually on top of the standard premium of $202.90 per month. And the IRMAA determination relies on income from 2 years prior. So a conversion she executes in 2026 affects her premiums in 2028. The third cascade is the widow and widower tax trap. If Margaret is married, the math shifts. For a married couple filing jointly, the standard deduction equals $32,200. The 12% bracket extends up to $100,800. The IRMAA threshold sits at $218,000. Everything is broader, more lenient, more breathing room. But when one spouse passes away, the surviving spouse files as single the following year. The standard deduction drops to $16,100 plus the senior edition of $20,050. The 12% bracket contracts to $50,400. The IRMAA threshold falls to $109,000. The brackets get sliced roughly in half, but the RMD does not. The IRA balance remains the same. The mandatory distribution is the same dollar figure, but it is now being taxed within a bracket that is half as wide. A married couple with combined income of $80,000 in the 12% bracket can transform into a single filer with $70,000 in the 22% bracket overnight. Not because they earned more, because they lost a spouse. The IRS does not mail a condolence letter. It mails a higher tax bill. For retirees with sizable traditional IRAs, the widow and widower trap is the most devastating tax event that nobody plans for. The RMD that was manageable in the joint bracket becomes punishing in the single bracket. The IRMAA threshold that was safely above your income is now dangerously close. And every year the RMD keeps arriving regardless of your filing status. Let me walk you through the numbers. A married couple, both 75, combined Social Security of $40,000, traditional IRA balance of $800,000, RMD of roughly $32,520. Total income, $74,520, plus some savings interest. After the joint standard deduction of $36,300, their taxable income comes to about $40,200. They sit comfortably in the 12% bracket. Federal tax around $4,800. The husband passes away. The surviving wife now files as single. She retains the higher of the two Social Security benefits, roughly $22,000. The IRA balance remains the same. The RMD remains the same, but the standard deduction drops to $18,150. The 12% bracket contracts to $50,400. Her taxable income lands at roughly $36,270. That does not seem much different until you grasp that the Social Security cascade shifted too. As a single filer, the thresholds are $25,000 and $34,000 instead of $32,000 and $44,000. Her provisional income drives her deeper into the 85% zone than the couple was. Her federal tax climbs to roughly $5,100. A $300 increase sounds minor, but that is just the first year. As the RMD grows and the IRA balance stays inherited at the full amount, the gap broadens. Within 3 years, the surviving spouse can be paying $1,500 to $2,000 more annually than the couple was paying together. The fourth cascade is the capital gains rate bump. This one stays invisible to most retirees and it costs them thousands. In 2026, the 0% long-term capital gains rate applies to single filers with taxable income beneath $49,450 and married couples beneath $98,900. That means if your taxable income stays low enough, you can sell appreciated investments held in your taxable brokerage account and pay zero federal tax on the gains. But when the RMD drives your taxable income above those thresholds, your capital gains rate jumps from 0 to 15%. On a $20,000 capital gain, that comes to $3,000 in tax that you would not have owed if the RMD had not been there. The RMD is not just taxing itself. It is pushing your capital gains into a higher rate. It is pushing your Social Security into the taxable zone. It is pushing your Medicare premiums into surcharge territory. One mandatory distribution generates 4 separate tax consequences. Now, here's the part that should genuinely anger you. The retiree who saved $500,000 in a traditional IRA and $100,000 in a Roth pays dramatically less in lifetime taxes than the retiree who saved $600,000 in a traditional IRA and 0 in a Roth. The same total savings, the same retirement, the same lifestyle. But the person who divided their savings pays tens of thousands less because the Roth dollars are invisible to the IRS. They do not count toward provisional income. They do not trigger IRMAA. They do not push capital gains into higher brackets. They do not generate RMDs. The tax code rewards the retiree who saved less in the traditional account and more in the Roth. It punishes the retiree who saved everything in one place. The person who saved everything in one place is typically the person who followed the default settings on their 401k for 30 years without anyone walking them through the consequences. Let me make this concrete with 2 retirees. Both are 75. Both hold exactly $600,000 in total retirement savings. Both receive $24,000 in Social Security. Both need $60,000 a year to live. Retiree A holds the full $600,000 in a traditional IRA. She takes her RMD of roughly $24,390 and pulls an extra $12,000 to cover living expenses. Total IRA withdrawal $36,390. Her provisional income equals $36,390 plus $2,000 in savings interest plus $12,000, which is half her Social Security. That totals $50,390. She sits deep in the 85% Social Security zone. About $2,400 of her Social Security is now taxable. Her total taxable income after the standard deduction of $18,550 comes to roughly $38,640. Federal tax roughly $4,300. Retiree B holds $350,000 in a traditional IRA and $250,000 in a Roth. She takes her RMD of roughly $14,227 from the traditional IRA. She withdraws the remaining $22,000 she needs from the Roth tax-free. Total taxable IRA withdrawal $14,927. Her provisional income equals $14,927 plus $2,000 plus $12,000. That totals $28,927. She sits in the 50% Social Security zone, not the 85% zone. About $6,114 of her Social Security is taxable. Her total taxable income after the standard deduction, roughly $2,191. Federal tax, roughly $219. Same total savings, same lifestyle, same Social Security, same age retiree. A pays $4,300 in federal tax. Retiree B pays $219. The gap is $4,081 each year. Across 15 years of retirement, that comes to over $61,000. And that is just federal tax. Add state taxes, the IRMAA exposure gap, and the capital gains rate gap, and the difference broadens to $80,000 or more. That is the paradox. The system penalizes the people who followed the rules the most faithfully. If you have stuck with this video this far, you are exactly the type of person this channel is built for. Hit the like button right now. It takes 1 second, and it signals YouTube to share this with more retirees who need to see this math before their RMDs begin. And if you are not subscribed, do it now. The video I'm releasing next week is going to reveal exactly how much of your 401k truly belongs to you after the IRS takes its cut, broken down by age. Now let me walk you through the 5 moves that fix this. All legal, all available right now, and the sooner you start, the more money you keep. Move 1. Roth conversions during the gap years. The gap years are the years between your final paycheck and the age when RMDs kick in, which is 73 if you were born before 1960, or 75 if you were born in 1960 or later. During those years, your income sits at its lowest. You are not earning a salary, you may not be receiving Social Security yet, your RMDs have not begun. This is the most tax-efficient window of your entire adult life. During the gap years, you can shift money from your traditional IRA into a Roth IRA at dramatically lower tax rates. The amount you convert is taxed as ordinary income in the year of conversion. Clears throat. But once it lands in the Roth, it grows tax-free, comes out tax-free, generates no RMDs, and stays invisible to the Social Security taxation formula and IRMA. For a married couple with no other income in 2026, The 12% bracket allows roughly $100,800 of taxable income after the standard deduction. If their only income comes from controlled IRA withdrawals, they can convert approximately $133,000 at a blended rate of about 10%. The math is staggering. A couple who converts $400,000 across 5 gap years at an average rate of 12% pays roughly $48,000 in conversion taxes. That same $400,000 left sitting in the traditional IRA and forced out as RMDs at an effective rate of 25 to 30% across 20 years cost them $100,000 to $120,000 in taxes. The conversion saves them $50,000 to $70,000 on the same money. But the gap years are limited. Every year you wait, the window narrows. Once RMDs begin, the conversion math becomes harder because the RMD income fills the lower brackets first. Move 2. Qualified charitable distributions. If you are 70 and a half or older and you donate to charity, the QCD is the most tax-efficient route to do it. You can give up to $111,000 per year directly from your IRA to a qualifying charity. That gift counts toward your RMD but does not register as taxable income. It does not appear in your adjusted gross income. It does not raise your provisional income. It does not trigger IRMAA. Compare that to the standard route. You take your RMD, the income lands on your return, it pushes Social Security into the taxable zone, and then you write a check to charity from your bank account. You might receive a charitable deduction if you itemize, but most retirees claim the standard deduction, so the charitable contribution provides them zero tax benefit. With a QCD, the money flows directly from the IRA to the charity. The RMD is satisfied, your AGI does not climb, your Social Security remains less taxed, your IRMAA stays beneath the threshold. Same gift, dramatically better tax outcome. If you are giving $5,000 or $10,000 a year to your church, your alma mater, your favorite charity, and you are not channeling it through a QCD, you are handing the IRS money you do not need to hand them. Move 3. Strategic withdrawal timing. Not all dollars are equivalent in retirement. The order in which you draw from different accounts has a massive impact on your lifetime tax bill. The general framework reads as follows. In years when your income is low, draw from your traditional IRA and execute Roth conversions. Fill the 12% bracket deliberately. In years when your income is high, draw from Roth accounts or taxable accounts with low embedded gains. Keep your provisional income beneath the Social Security thresholds and your MAG beneath the IRMAA thresholds. The crucial insight is that your taxable income is not fixed in retirement. You command it. You determine how much to pull from which account in which year. The retirees who treat this as a strategic decision save thousands. The retirees who pull from the largest account on autopilot pay the maximum. Move 4. The senior bonus deduction. The One Big Beautiful Bill, signed into law in 2025, established a new deduction for taxpayers 65 and older. $6,000 per qualifying person, $12,000 for a married couple where both spouses are 65 or older. This deduction was specifically crafted to offset the Social Security taxation problem. The income phase-out begins at $75,000 for single filers and $150,000 for married couples filing jointly. Beneath those limits, you receive the full benefit. At a 12% rate, the deduction saves a couple $440 each year. At 22%, it saves $2,640. This deduction is temporary. It runs from 2025 through 2028 only. If you have not claimed it on your 2025 return, file an amended return within 3 years. Ask your preparer specifically whether they applied the senior bonus deduction from the One Big Beautiful Bill. If they don't recognize what it is, find someone who does. Move 5. Rebalance your account types before it is too late. If you are still working, you have one advantage that retired people lack. You can choose where your next dollar of savings goes. If your 401k provides a Roth option, use it. Every dollar that flows into the Roth side is a dollar that will never generate an RMD, never trigger the Social Security torpedo, never push you into IRMAA territory. If you are between 60 and 63, the Super Catch-up provision allows you to contribute up to $11,250 in additional catch-up contributions. If your prior year wages fall below $150,000, those catch-ups can go pre-tax. If above, they must be Roth. By the way, the Roth option is almost always better for people who already carry large traditional balances. The goal is not to have the largest retirement balance. The goal is to have the right mix. $1 million split between 600,000 traditional and 400,000 Roth will produce dramatically less lifetime tax than $1 million all in traditional. Same total, different outcome. The IRS takes less from the split portfolio because the Roth portion is invisible to every cascade I demonstrated today. Let me bring it all together with Margaret. Margaret is 66 with 1.1 million parked in a traditional IRA. She has 9 years before RMDs kick in at 75. If she does nothing, her first RMD at 75 will be roughly 40 by 700. Combined with Social Security, it drives her into the 85% SS taxation zone, tax on roughly $3,400 in federal tax from the SS cascade alone, and places her near the IRMAA threshold where any added income, even a small capital gain, could trigger nearly $1,000 in Medicare surcharges. If instead she converts $80,000 each year for 5 years during her gap years at the 22% bracket, she pays roughly $88,000 in conversion taxes across 5 years. That sounds painful, but don't it removes $400,000 from the traditional IRA. At 75, her remaining balance comes to roughly $800,000 with growth instead of $1.3 million. Her first RMD falls from roughly $45,000 to roughly $33,000. That smaller RMD keeps her Social Security in the 50% zone instead of the 80th percent zone. It keeps her below IRMA. It keeps her capital gains in the 0% bracket. The lifetime tax savings from those 5 years of conversions, when you total up the lower SS taxation, the avoided IRMAA surcharges, the 0% capital gains rate preserved, and the tax-free Roth growth, surpasses $150,000 across a 25-year retirement. Margaret saved $1.1 million across 32 years. The 5 years of Roth conversions saved her $150,000 of that across retirement. Nearly 14% of her total savings shielded from the IRS by spending $88,000 in conversion taxes to save $150,000 in lifetime cascading taxes. The retiree who saved more paid more in taxes. The retiree who converted and spent strategically retained more. That is the paradox, and the IRS will never explain it to you. Here is what I want you to do right now. 3 things. First, examine your traditional IRA or 401k balance. If it sits above $500,000, you're inside the tax torpedo zone. The RMDs on that balance are going to push your Social Security into the 85% zone and potentially trigger IRMAA. You need a conversion plan. Second, calculate your gap years. When will you retire? When do RMDs begin? That is 73 if you were born before 1960, or was 75 if you were born in 1960 or later. How many years of low-income conversion space do you have? Every year of that window you leave unused is a year of conversions you cannot reclaim. That answer tells me exactly what to cover in the next deep dive video, and the most common answer becomes next week's full episode. If this helped you, hit like, subscribe if you have not already. I produce videos like this every week, and the next one, the 401k by age video, is going to transform how you view your retirement balance. I will see you in the next one.